Let me ask you something. Are you accidentally leaving money on the table every single tax season? Well, most Canadian families are. We're talking about thousands of dollars in savings missed just because we don't know all the rules of the game. Today, that changes. We're going to break down the strategies that can literally transform your family's financial future. Okay, let's get into it.
Well, hello there. I'm Gemini.
And you know what? This quote is our starting point. Taking control of your family's money isn't about becoming a tax wizard overnight. Nope. It's just about taking that first step. And this right here, this is that step.
Okay, so what you're looking at on the screen, that is not a lottery number. That's the potential tax savings a family with a small business could rack up over 40 years just by using some smart income-splitting strategies. Yeah, you heard that right, $400,000. That's what's at stake here. That's the real power of planning.
So here's our game plan for today. We're going to start with the high cost of, well, doing nothing. Then we'll get into a whole new mindset, thinking like a team. From there, we'll hit the core strategies for your income and investments, find some hidden tax savings you might be missing, and then, the best part, we'll build your personal action plan.
Let's kick things off by busting a huge myth. You know that happy little dance you do when you get a big tax refund? It might feel good, but it's kind of a trap.
And this is the point, right here. A refund just means you overpaid your taxes all year long. That's your hard-earned cash just sitting in the government's bank account, not earning a single cent of interest for you. I mean, that's money that could have been in your pocket, chipping away at your mortgage, or, invested in actually growing for your family. Over a lifetime, that lost opportunity, it's just massive.
Okay, so to stop leaving all that cash on the table, we need to make a really fundamental shift in how we think. It's time to stop seeing yourselves as just separate earners and start operating like a single, unified financial team.
Let's make this feel a little more real. I want you to meet the Hamptons. So you've got Tom, he's an employee making about $120,000 a year. His wife, Helen, she runs a pretty cool craft business from home, part-time. And their kids, Suzanne and Cal, they've got part-time jobs too. Now, they're a hard-working family for sure, but like most of us, they're not really coordinating their finances to pay less tax. We're going to use them as our guinea pigs today.
And this is the big goal. By acting as a tax-wise economic unit, the Hamptons and you can legally arrange your finances to pay the absolute least amount of tax possible. Now, let's be clear. This isn't some shady tax evasion scheme. This is about being tax efficient. It's about unlocking more of your own money so you can build your own wealth.
Okay, so how do we actually pull this off? Well, this whole team mindset is built on 3 key strategies for managing your family's income. We're talking splitting it, shifting it, and sheltering it.
So the first, most basic goal for any family team, I'm talking ground zero, is making sure every single person in the family uses up their personal tax-free zone. Here in Canada, everyone gets what's called a basic personal amount, or BPA. It's a chunk of income you can earn completely tax-free. So my question to you is, are your kids, or maybe a lower-earning spouse, using all of theirs? Because if they're not, you're literally leaving free money on the table. Now check this out, because this is how our tax system works. It's progressive, which means the more you earn, the higher the tax rate you pay on your next dollar. That's your marginal tax rate. For our family, the Hamptons, the money Tom earns at the top of his salary is taxed way higher than what his kids make at their part-time jobs. And that difference, well, that's our opportunity.
And this, my friends, is where the magic happens. This is the power of income splitting. So instead of all that income getting taxed in Tom's super high tax bracket, what if Helen's business paid her and their son Cal a fair wage for the actual work they do? By shifting just $25,000 to Helen and maybe $12,000 to Cal, who are both in way lower tax brackets, the family's total tax bill could drop by about $10,000 a year. And that's the $400,000 savings we saw earlier, just rolling and compounding over time.
But hold on. Before you get too carried away, it's not a complete free-for-all. The Canada Revenue Agency has these things called the attribution rules. Basically, they're designed to stop you from just handing a pile of cash to your spouse or kid to invest just so the earnings get taxed at their lower rate. It's a really critical hurdle, but one we can navigate properly.
So let me give you a super clear example of how this works. Let's say Tom gives Helen some money, and she puts it into a regular, non-registered investment account. Well, the CRA is going to attribute any income from that right back to Tom, and he's going to pay the tax at his high rate. Bummer. But if he gives her that exact same money and she puts it into her own tax-free savings account, boom, all the growth is tax-free. Or they could use a spousal RRSP. Tom contributes to an RRSP in Helen's name. Tom gets the tax deduction now, but when that money is taken out in retirement, it's taxed as Helen's income, probably at a much lower rate. See? It's all about using the right tool for the job.
And look, there are several powerful and totally legitimate ways to work around these attribution rules. You're not stuck. You can gift money for a TFSA, you can pay family members a reasonable wage for real work in a family business, you can invest a lower earner's own money, like from an inheritance, you could even set up a formal loan between spouses that charges interest. These are the CRA-approved tools in your tax-wise family's toolbox.
All right, so we've got our income optimized. Now let's talk about making that money really work for us. Because it's not just about how much money you invest, it's about where you invest it. That part is huge.
I want you to think of your investments like a waterfall, okay? Your very first investment dollar should always cascade into the tax-free savings accounts for every adult in the family. Why? Simple. All the growth inside a TFSA is 100% tax-free, forever. Once those are full, the water overflows into your registered accounts like RRSPs and RESPs to get those great tax deductions and government grants. Only after all those are maxed out should you even think about putting money into non-registered taxable accounts. Now this chart, this is so important because when you do invest in those taxable accounts, you need to know that not all income is treated the same by the taxman. I mean, look at the difference here. Interest income, it gets taxed at your full marginal rate. But capital gains, that's the profit when you sell an investment, only half of it is taxable. And Canadian dividends get special treatment too. What this means is choosing the right kind of investment for the right kind of account can literally save you a fortune over time.
So, we've planned our income, we've planned our investments, we are in the home stretch. Now it's time for the final piece of this puzzle, filing your taxes and making sure you claim every single deduction and credit you're entitled to. No exceptions.
Okay, the tax code is, let's be honest, a beast. But here are some of the most common and most often missed deductions for families. I mean, sure, RSSB contributions are obvious, but are you claiming all of your eligible childcare costs? What about medical expenses for things like braces or glasses? Or all those charitable donations you made? Every single dollar you deduct here lowers your taxable income. Don't leave it behind.
And for anyone with investments or a business, like our friend Helen Hampton, the opportunities just multiply. You can deduct the fees you pay for investment advice. You can write off investment losses against your gains. You can claim a chunk of your home office and car expenses. And see how it all connects? That salary paid to family members? It's a powerful deduction for Helen's business, and it helps with the income splitting we talked about. It's a total win-win. Wow, we have covered a ton of ground here. We've totally shifted our mindset from being individual earners to being a powerful financial team. We've learned the strategies for splitting income, investing smarter, and we've uncovered those hidden savings. Now, it's time to bring it all home.
Look, everything we just went over, that's your blueprint for a more secure financial future. You get it now. You understand the core ideas of treating your family like an economic team, splitting income smartly, and investing in a tax-efficient way. The journey from knowing this stuff to actually building wealth, it starts with just one conversation. So the ball's in your court. What's the first question you're going to ask?